Okay, well, welcome everybody to the Nest Insight Conference 2025. It's great to see so many people here, some who we've had at previous events and some new faces, which is really exciting. I'm Will Sandbrook, I'm the Managing Director of Nest Insight. It's great to see you all. We're super excited about today's program. Apologies that we've managed to select the hottest week of the year in which to hold a conference, although I don't know how many veterans of our earlier events there are here, but some of you may remember in 2017, we held this event on the roof of the National Theatre on what was then the hottest day of the year, and trust me, that was worse. By the end, everyone was kind of 40 yards away outside the marquee trying to get whatever sort of remnants of fresh air there were. So I'm hoping it's a little bit more comfortable today, but obviously look after yourselves, keep hydrated. If you need to get up and find some air, then please do that. In a minute, I'm going to just reflect a little bit on today and how we put the agendas together and try to set the scene a little bit. But before I do that, one of the things we've tried to do with Nest Insight is really to centre the lived experience of low and moderate income households, who after all are the real experts, both in understanding the challenges that they face in managing their finances, but also what good solutions are likely to look like. And so before hearing from me, we're just going to hear for a minute from a couple of them.
Having a child, the financial responsibilities become different. Whatever your typical outgoings are will always be there, but then you have additionals, whether it be clothes, shoes, activities. That's where you then have to factor in your financial responsibilities, making sure that there is something to fall back on. Having that backup is very important sometimes, and it can become difficult if you don't have that there.
Hiya.
Hey, nice to meet you. I'm Tracy.
Nice to meet you. I'm Annika.
You were on the Real Accounts project, weren't you?
Yeah, I remember you from that as well.
Remember you too.
What do you do for work?
I am a civil servant, been doing it for over 20 years now.
Wow.
Yeah. What's your background? What do you do?
I work at a library. I'm a facilities manager, so basically look after the building.
Sounds like a busy job.
What does financial resilience mean to you?
My version of it would mean to have some kind of control over your finances, being able to manage your income and your expenditure.
Financial resilience, I guess it means different things to different people, but I think for me, just kind of having that peace of mind of having a bit of a buffer, knowing that you'll be able to weather through a bad time or an emergency, basically. If you asked me 5 years ago what financial resilience was, it might be something I wasn't thinking about that much, and I feel like it's something I think about a lot more.
Yeah, at the time it sounds great to have, these credit cards and overdrafts, but now people are paying bills with credit cards and trying to find alternatives.
Payday loans or credit cards and getting into debt. More just for kind of daily life.
I think there's a lot of trying with saving, and you're trying to keep it to your potential budgets, but it doesn't always go that way. For some people, it's overwhelming. It's hard to get out of.
Because it is often, there's so much shame around it. People are less likely to ask for help and talk to their friends and family about it as well. I think institutions can view people with kind of low financial resilience not as viable customers.
Unfortunately, when you have that lower income, you come across the battle of being able to prove that you are responsible to make the same payments as somebody who was more financially resilient.
If you could change the system, what would you change?
With a lower credit score, you're not deemed to be maybe as perfect as somebody with a higher credit score. Lenders, insurance companies, they will see things and they'll be like, no, we can't offer that to you. Or they will offer it to you, but at higher interest rates. Sometimes it can make you feel worse because you may be potentially trying to do something to better yourself. If the government were to step into a person's shoes and what their potential struggles and finances are, they'd probably have a better understanding of what that person has to do in their financial life.
Okay, we'll hear a bit more from our experts in action later on. So Nest Insight was established 9 years ago now by Nest as an investment in a broader public benefit mission to support those on low and moderate income to achieve financial security both today and through into retirement. We do that with a focus on testing and evaluating real-world solutions, building the evidence base for what really works, and using that evidence base to build momentum behind the adoption of solutions at scale. Back in 2016, we were struck by the dichotomy that we'd successfully, in the UK, enacted a solution that had millions more people saving for retirement, many for the first time, and who were now building up meaningful wealth and assets. But many of those people were also living on relatively low incomes, facing challenges in their everyday finances and with their standards of living. And millions of the auto-enrollment cohort were now saving for the first time in a pension, but perhaps doing no other saving, for example. Since then, the financial challenges facing those households have arguably only become harder. Long-term trends like stagnant real incomes, rising housing costs, and for many, rising levels of student debt have continued, but we can add to those more acute crises in the form of COVID and the cost of living crisis. We also shouldn't forget that auto-enrollment, though it brought millions more people into pension saving, also left millions of others, particularly the self-employed, outside and without such a solution. So financial security, both for today and for tomorrow, is unevenly distributed, not just around the obvious parameter of income, but also around other key aspects of people's lives, a homeowner or not, self-employed or traditionally employed, as well as with other clear inequalities across other diversity paradigms, particularly gender and ethnicity. And at the core of all of this is a massive challenge with low financial resilience. The FCA's Financial Lives Survey estimates that 13 million UK adults live with low financial resilience today. Over the last year, we've continued to work to try to find solutions to these challenges and to test and scale them. And to share a few highlights from that work. We published our Real Accounts work, which followed the financial lives of 44 households in depth for a year. That work shone a light on the significant additional challenges created for people by volatile incomes over and above their low incomes, and introduced the idea of a volatility premium to help us to understand those challenges. Financial volatility, especially when combined with low income, creates a massive cognitive burden for people. It requires them to constantly innovate in managing their money, but that innovation is often about working around the formal system, which is not always designed with their needs in mind. That work suggests that policymakers, employers, and financial services providers need to both help where they can to smooth people's incomes, but also to design inclusively for those on volatile incomes by building flexibility into the system, for example, by the use of things like variable recurring payments. We also published a major piece of work last year on retirement income adequacy, which highlighted the need for discussions of adequacy and for the objectives of the retirement system to understand the interactions between pension saving and working age living standards. For the roughly 5 million people who earn less than the full-time national living wage, but more than the auto-enrollment threshold, even where some of those people appear not to be saving enough to achieve an adequate income in retirement, it's not necessarily fair or realistic to expect the solution to that to be that they should make higher pension contributions in working age. We published a major summary report on our work on workplace emergency savings at an event in March, bringing together all of the work from the opt-out trials phase of that work. That work continues to show that opt-out workplace savings tools are highly effective in improving financial resilience, and they complement the pension savings system. And we continue to work closely with government, regulators, employers, and providers to figure out how to bring those models to scale. We launched work looking at other mechanisms to help people to build financial resilience, including testing and evaluating savings and debt hybrids. We've launched new work looking to fill the evidence gaps around the relationship between pension assets and supporting home ownership, a set of ideas that's clearly growing in interest in the public policy debate, but around which we urgently need a better evidence base if those are ideas that are going to come under serious consideration. And just a couple of weeks ago, we published findings from the most recent phase of our work on increasing long-term saving among the self-employed, evidencing the potential effectiveness of default solutions for that group. All of these projects are delivered in collaboration, and I'm grateful to all of our research and delivery partners, and in particular, I'd like to thank our funding partners whose support makes all of this work possible, in particular, our strategic partners, the BlackRock Foundation, JP Morgan Chase, and of course, Nest. Our work is about creating the evidence base to support decision makers in thinking through how to support improved financial security. That's decision makers in public policy, in employers, and in product providers. It's about new innovations, but it's also about better evidence for existing innovations and interventions. There's lots of things connecting these different strands of our work and lots of common themes emerging, but I want to just focus on a couple. First, that people's lives, and as part of that, their financial lives, are messy and interconnected. The household from our Real Accounts work who was moving money between different of their own accounts 150 times in a month is not separately sitting down and making considered long-term decisions about their retirement saving. Yet we often interact with people in silos around different aspects of public policy or product interventions as if they're somewhat unconnected to one another. And if we do that when we think, for example, about phase 2 of the pensions review and the adequacy only of their pension savings, there's a danger that we act with good intentions, but actually in ways that create quite bad outcomes for some of those people. And the second point follows on from this, which is that we need, as far as possible, to look at potential solutions also in a joined-up way. Financial resilience connects so many different social policy challenges and is a fundamental precursor to wider financial security. It's a central plank of the government's financial inclusion strategy and of their child poverty strategy. It's a critical underpin to longer-term and retirement saving. It can help to address money-related mental health challenges and to create the economic independence needed to help people to escape abusive relationships. And just as it connects these issues, solutions are also likely to be interconnected, which too has been a theme of our work. We've looked at pensions and savings hybrids, ideas that connect housing and pension saving, at debt and savings hybrids, and at recognising that including some liquidity in retirement solutions for the self-employed may better suit their needs than a pure pensions product, for example. This focus on connecting dots, both in understanding the problems and in setting the solutions, is a big part of how we've put today's event agenda together. This morning, we'll talk about how we can move the arguments for supporting financial resilience from more micro and household level ones to the broader social policy, macroeconomic and commercial arguments for scaling solutions. In the lunch break, our marketplace outside will show, sadly not outside, just out there, will showcase the various pieces of research that I mentioned earlier on. And this afternoon, we'll go deeper into one aspect of this interconnected system when we hear from our keynote, Helen Undy, about the interactions between financial health and mental health, before finally, in our last panel, focusing on some of the emerging solutions and interventions that we think have merit and should be considered further. We've got a great lineup of speakers today. We've worked hard to bring an excellent group of people together, but the purposes of doing that, the purpose of bringing those voices up here is to spark debate out there and amongst you. We want your questions and we want people to connect during the conversations, but also in the breaks, and to continue the conversations in the networking parts of the day, and of course far beyond today as well. So thank you for your help in advance with that. Okay, I'm now going to hand over to our first panel. So I'd like to introduce our first moderator. Nida Broughton is the UK Managing Director at the Behavioural Insights Team, still known affectionately to some of us as the Nudge Unit, leading their work across the United Kingdom. She was previously co-director of economic policy, overseeing their work on consumer policy, business regulation, long list, economic growth, sustainability, and EDI. She's also the author of BIT's flagship publications, The Behavioural Economy and Boosting Businesses, and oversees their groundbreaking work on gambling research. Prior to working at BIT, she was chief economist at Social Market Foundation, leading policy research on economic growth, public spending, and employment, and has also worked at the House of Commons and at Ofcom. So I can't think of anyone better placed to guide us through the next part of the discussion. And welcome on stage, Nida.
Wonderful. Thanks so much for that introduction, Will. So really exciting panel this morning. We just heard from those kind of really, I guess, powerful kind of lived experiences at the start of the session. And I'm supposed to kind of add some stats to that. A quarter of the adults in the UK have less than £100 in savings. So that's really, really low financial resilience. And, you know, this is a self-selecting group of people that have chosen to come to this event today. So I don't think anyone would disagree that we need to do something about that. And many of us in the room have done a lot on it already. We've done a lot of research, developed new products and services, rolled them out, evaluated them. Will there spoke about some of the really excellent work that Nest has done to develop and test new ideas, things like opt-out savings products, learning from the success of auto-enrollment in pensions, and that's all kind of really brilliant. But, and unfortunately there is a but, I think we also all know that one good evaluation or even several great evaluations don't always change the world. And so that's really what we're here to talk about today, is how can we scale up these really excellent ideas? How can we convince employers, convince government to start actually taking up these savings products? Encouraging their widespread adoption so that more and more people can build their financial resilience. And, you know, we're asking this question in some ways in quite a difficult climate. So for employers, you know, there are many great employers out there who are really invested in creating great workplaces. And there are many who are really invested in improving the financial well-being of their staff. But at the same time, employers have a lot on their plates. The cost of employment is going up. They face skills gaps, adapting to new technology, staying competitive. So there's a lot there. And then in terms of government, the Prime Minister has said that economic growth is the #1 priority for this government. And it has to be, right? I mean, those of us who remember pre-financial crisis will remember the good old days where economic growth was regularly 2 to 3% per year. Now we think 1% a year is good. And that's a real problem for the government, because without that growth, it doesn't get those tax revenues in. It's having to either borrow more or cut spending. And, just this past week, I think we've seen that terrible dilemma facing government and Labour MPs around, how much do we cut the welfare bill to try and balance the books? These are not great dilemmas to be facing. And that means that for us, when we're thinking about making the case for policy ideas, we need to be thinking, okay, how do they contribute to that #1 priority of economic growth? And B, ideally not cost too much either. So that's the context for the comments that the great panellists here are going to make. We've got to begin with Vivien. She's senior researcher at NEST, and she's going to be talking about her current work on the link between financial resilience and the wider economy. Prior to NEST, Vivien was at the International Longevity Centre. She's also an associate professor at the University of Reading, and she's working on a textbook on the economics of the public sector due out next year, I believe. And then after we've heard from Vivien, we're going to go to Joanna Legg. So Jo is Head of Consumer Policy and Outcomes at the Financial Conduct Authority. She's responsible for the FCA's cross-cutting consumer duty work, as well as leading on vulnerability and financial inclusion. She previously led the FCA's Financial Lives Survey, and she's going to be talking to us about her work looking at the interdependencies between financial resilience and the wider system. And then finally, we're going to hear from Robert Lovesey. So Robert is Business Development Manager at Serve and Protect, the credit union. He's worked in the credit union sector for over 15 years, working closely with stakeholders and employers across the whole public sector, military, fire, health service, police, to work with them to introduce approaches and products and services that support employees and staff to develop their financial resilience. And Serve and Protect is the largest employer credit union in the UK, serving over 53,000 members. So he's going to share a lot of the sort of experiences that he's had working with employers to roll out products and services to improve financial resilience. So lots to cover today. I'm going to hand over to Vivien to kick us off to talk about her work.
Thank you very much. And yes, it's great to be here. So we know from an individual perspective, we know there are lots of good reasons for supporting financial resilience. I think what we know less about is how these individual level effects feed into the wider economy. And that's really one of the aims of this program of work that NEST Insight embarked on at the start of this year. So we want to try and assess the sort of wider economic impacts of supporting financial resilience among workers with low, moderate, volatile incomes. And as part of this program of work, we've collaborated with Pro Bono Economics to, in a first stage, develop a logic model. And so I've got a very simplified version of that model up here. And what we've tried to do with this model is to map out the various channels through which improved financial resilience might affect the wider economy. And as you can see, it focuses on 3 core areas. So we're looking at household relationships, work and productivity, and financial participation. And if we think of household relationships, for example, improved financial resilience can help create a more supportive home environment, which might sort of lead to improved school attendance and performance among children, which will then potentially have a knock-on effect to their earnings and employment prospects once they reach adulthood. In the context of work, we can think, for example, of the sort of emerging evidence that suggests that improved financial resilience reduces stress and it helps reduce cognitive loads, so potentially having a positive impact on both physical and mental health. And this in turn can help reduce workplace accidents and also increase in-work productivity. And lastly, if we think of sort of financial participation, you know, if households or individuals or households are more financially resilient, then there's a reduced reliance on high-cost credit, for example, potential to reduce poverty premiums, as well as a potential to support individual wealth accumulation. So combined, all of these individual level effects potentially could lead to increased labour force participation for the wider economy, reduced government spend on welfare and health, for example, as well as improving tax revenues and potentially increasing economic growth. Now, as I said, this is a very sort of simplified version of the model, and I wouldn't want to suggest that all of the impacts of improved financial resilience will necessarily be positive. So, for example, if improved financial resilience means that households are less reliant on high-cost credit, this is, of course, going to have implications for businesses that supply those forms of credit. But one thing that the model does highlight is that there are also significant potential benefits for businesses and employers, namely through the impacts on individual health and well-being, and how these might then feed into reduced absenteeism, for example, and increased productivity. So there is a clear incentive for businesses and employers to want to support financial resilience of their workforce. And there is already some emerging evidence in this space. So there are a couple of very interesting studies for the US that came out, I think, this year, looking at the links between financial resilience, namely through access to workplace emergency savings schemes, and how these affected employee performance. So there's a study by Carrie Liana and her co-authors, and they looked at truck drivers, and they found that having access to emergency savings had a significant impact on performance, measured in terms of sort of reduction in the number of driving penalties and offences, and a reduction in the number of accidents. There was also a slightly broader study that looked at a wider range of people employed in a wider range of sectors, and that found again that having access to these emergency savings had an impact on not only self-assessed performance at work, but what we might think of as some, I guess, more objective measures of work performance, so looking at the likelihood of receiving a pay rise or a promotion, for example. And the study also found that there were lower turnover rates, so actually having better financial resilience had a positive impact in sort of supporting employers to retain workers. So what we're trying to do as part of our sort of work program is to bring together the evidence that's already out there, but also to try and identify gaps and to try and sort of collect and analyze evidence to fill some of these gaps. So, for example, exploring in a bit more detail how financial resilience affects individual health and well-being, and how this can then affect employment outcomes, so looking at hours worked and the types of jobs that people go into, but also wanting to unpick a bit more the relationship between improving financial resilience and other financial behaviours. Now, I wouldn't want to suggest, so economic growth is obviously an area that we're very much interested in, but it's not the only thing we're interested in. And also we want to think about how these sort of different impacts feed into the type of growth we're seeing. But we're also interested in sort of thinking about broader impacts. So how do these things affect individual well-being as well? Because this will also have a sort of spillover effect to the wider economy. And obviously, I think, so what we're trying to do really is highlight the wide range of ways in which financial resilience does have these sort of individual level effects, and how they then sort of aggregate up into the wider economy. And this is obviously important in the context of the government's economic growth agenda, but it also feeds into other key areas of public policy. So it'll have implications for the child poverty strategy, for example, or strategies for tackling economic abuse. And I guess just to sort of wrap up, I think one other thing worth highlighting in this context is that the sorts of financial resilience interventions that we're thinking of are ones that are potentially low or imply a sort of low cost for the government and for taxpayers. So there are things that can be, I don't want to say easily implemented, because I guess nothing's really easy, but can be fairly costlessly implemented, and the potential benefits are quite significant. So I think I'll leave it at that and pass over to...
Brilliant. Thank you so much, Vivi. Yeah, over to you, Jo.
Thanks very much, and thanks a lot to Nest Insight for the invite. That's quite hard to say. It's really great to join the discussion. I wanted to start just by showing you some of the findings from the latest Financial Lives survey, which we published in May. I hope many of you here are familiar with the Financial Lives survey, or FLS, if not indeed genuine fans. It's a nationally representative survey that we carry out every 2 years to inform our work and priorities, and we do a report on all of the findings, but we also make the raw data available for anybody to access if they register. So if you haven't yet had a good look at it and you think it could be useful to you, please do. What does the FLS tell us about financial resilience? It includes a huge amount of evidence and insight about where consumers are at in their financial lives, hence the title, the sorts of barriers they face in accessing products and services, and what might drive those. Our most recent survey found, no surprises to anyone in this room, that financial resilience is not, a niche challenge, right? We're looking at 1 in 4 UK adults, so 24% of the population, 13.1 million people who have low financial resilience, and that figure's unchanged from 2022. And when we talk about financial resilience, we measure it across really 3 strands. So adults who are in financial difficulty, in effect because they're missing payments on domestic bills or credit commitments, and or those who are heavily burdened by their existing commitments, and or those with low savings. So you can see from this slide, I hope it's the right one. No, it's not. This one will help you. The groups most affected are unemployed adults at 50%, those with a household income of less than £15,000 per year at 48%, and renters at 46%. So I listed out those 3 dimensions of the way we look at financial resilience, but how do those break out? So you can see for 2024, 13% of adults, so that's 7.3 million people, were heavily burdened. 14% of adults, 7.6 million people, had low savings, and 8% of adults, so 4.5 million, were in financial difficulty. But there's a lot of overlap between those 3 strands, and the drivers aren't mutually exclusive. So the Venn diagram on the right there shows that. The most common driver is low savings, but 10% of those reporting low resilience are subject to all 3 drivers. If we look at each driver in a little bit more detail, and then I'm going to touch on capability and vulnerability as well. In 2024, the number of adults who were in financial difficulty was unchanged from 2022. But, tiny sliver of good news, the number of adults who were heavily burdened by bills was down 1 percentage point since 2022. We focus on those who are heavily burdened, but there's a broader point which I think is really important to factor in when we're looking ahead to longer term solutions to some of this. And that's that since 2020, there's been a large increase in the proportion of adults who are burdened keeping up with their domestic bills. So not heavily burdened, but burdened. And that's up from 52% in 2020 to 61% in 2024. And, Will mentioned a little bit of this in the introduction, but that clearly reflects factors such as the increased cost of living, higher rate of inflation. So although we've got this very small improvement in those who are heavily burdened, there's a distinct negative move for those who are just 1 rung away. Looking at savings now, I mentioned earlier that 7.6 UK adults have low savings, and that's unchanged from 2022. It can make it very difficult for consumers to manage unexpected expenses when things go wrong, and some of the things that Vivien was just talking about in terms of increasing stress and the impact on people's overall financial and general well-being. So you can see there that only 4.6 million adults could cover their living expenses for less than a week from our 2024 survey, so that's 9%. And that figure's much higher for some groups like lone parents, those with addiction, and those who aren't in work. And it's also higher for those with low financial capability. So that's the next dimension to look at for us. Financial skills and understanding are clearly critical to enable consumers to manage their finances effectively, access the right financial products for them, and make informed decisions in the short, medium, and long term. But in 2024, we're looking at 12% of UK adults with low financial capability, so that's 6.5 million adults, by which we mean that they rate their confidence managing money and their knowledge in terms of financial matters as very low. And in terms of who it impacts, again, we see here unemployed adults, those in low-income households, and actually those aged 18 to 24 are more likely to have low financial capability than the UK average. The slide breaks down a little bit more what that really means to people in their day-to-day lives as well. So, those with low capability report that they feel overwhelmed when they have to interact with providers. They find dealing with customer services, including on the telephone, very confusing and difficult. They don't feel able to shop around and switch financial products, and they put off or avoid making financial decisions. And this stuff can have, a huge impact on people's lives in the present, but also in the medium to long term too. We actually treat financial capability as got someone in the audience helping me. We treat financial capability as one of the drivers of vulnerability, right? So when we talk about vulnerability in consumers, we mean consumers due to their personal circumstances who are especially susceptible to harm, especially when they're not treated with appropriate care by their provider. And we work with these four drivers. So capability is one, but also poor health, negative life events, and low resilience as well being the others. And the last FLS for 2024 found that 49% or 26.4 million UK adults showed one or more characteristics of vulnerability in 2024. So protecting consumers with characteristics of vulnerability, including those with low financial resilience, remains a really important part of the work that we do at the FCA. Our recent review on this comprised some consumer research as well, quite detailed consumer research, and one of the elements that really came out was the impact of multiple characteristics of vulnerability on consumers. So we found that those with, poor health, low resilience, and a negative life event, for example, were much more likely to report that they tried to do something with their provider but were unable to do that. So just to conclude really briefly now, low financial resilience is clearly a really sticky problem. We have a growing cohort of consumers who are burdened by their basic spending commitments, and I think that's why initiatives like the workplace savings piece run by Nest Insight are so important. And we'd also encourage consideration of consumers' wider circumstances, including their characteristics of vulnerability, if any, to really focus on where progress can be made.
Wonderful. Thank you so much, Joe. Okay, Rob, do you want to go next? I believe
Absolutely.
You've got a video to start us off, haven't you?
Yeah, I don't know if it's starting us off or it's in the presentation. We'll see at a click of a button, but here goes. No, it's in the presentation. So good afternoon, everyone. Pleasure to be here. I've got 7 minutes, so apologies if I rattle through this relatively quickly. There's a lot to cover. So I work for Serve and Protect. We're one of the largest credit unions in the UK. We're joined by credit union folk in the audience, which is great to see. I'm just going to talk a bit about our journey as an organisation where we've tried to address financial resilience in the workplace, look at strategies to try and help colleagues save, and also themes that have emerged in terms of financial vulnerability. So to a bit of context, we are one of the largest. We look after over 53,000 members, over 100 million in savings, and we have about £86 million out on loan to members. So we're there as an option to help people save and an option if they need to borrow responsibly. It's just really important. When I come to these sessions and we talk about payroll savings, it's just good to acknowledge that credit unions have been doing payroll savings, since the 1980s. We have models, a lot of credit unions that have models that are working really well to build the resilience. And it's great that the most recent government have committed to cooperatives, as part of their programme of events for the future. So payroll deduction.
we serve 36 police forces via payroll, the prison service, the Ministry of Defence, and a range of health and fire and rescue services. Now, what do we find? Members save with us because the convenience of payroll, that is the main driver for them. It helps them save effortlessly and also helps them make timely repayments on loans. As mentioned, payroll's a thing, it's been successful, it's working well. My job is to engage with those employers to help set up those relationships, but also get their people saving. We try and help them resonate with the challenges, like the colleagues in the room have discussed. What are the drivers from an organisation's perspective? Sometimes you get lucky, people have been there, done it, and they empathise. Other times people are just looking at the bottom line. But you can see all of these aspects in whether it's home life, work life, impact the individual, and money plays a really important factor. I'm sure we're all well aware of this, so I'm not going to go into too much detail here. However, why are the markets we serve particularly vulnerable? And how do we resonate as a credit union with those stakeholders? Ultimately, over time, and I've been doing this job a fair few years, we've recognised that they recognise their people, they want them to be financially ready. If they're resilient, they can focus on their job in hand and go and serve the nation to the best of their ability. It's taken time, but the employers have really started to resonate with that and recognise that if people manage their money well, they're going to go and do their job in hand and protect us on the streets to a far better level. We've had cases, military equipment goes missing, sold on the dark web. Why are people selling that? Members of the armed forces, it's public information, it's in the press, because of financial struggles. We've had police officers, you can see in recent cases, people have had, challenges financially as to why they make these poor choices. So this is happening in and around, these markets we serve, and to the outsiders, people wouldn't necessarily think they were that financially vulnerable. They're all in paid employment and a career for life, unless they do something really stupid. So we establish, they have access to sensitive resources, high stress environments, risk of compromised integrities. These are part of their jobs. But if you engage with employers, or if you're an employer in the room, just start to think about the sort of data that maybe your colleagues have access to. There can be a value on that. So it's really important we try and encourage and find mechanisms to get people saving. So our mission, when I came into the Serve and Protect about 7 years ago, our focus was to improve the financial resilience of those who serve and protect. We do savings, we do loans, but we don't market that. We try and get our colleagues to resonate with the importance of building resilience, financial resilience. And we like to think we've done a reasonably good job. We've had about 26,000 members when we joined. 7 years ago, we've now got 53,000. So it's growing quite quickly. But how have we done that? So a couple of the key strategies I just want to share that have worked well. So these are 2 training establishments within the armed forces. Anyone that has served or is serving will recognise ATC Purbright. So since 2019, we've briefed on the induction programme, about 91 briefs, and you can see the stats that have started to develop since that time. It's really powerful in terms of the amount of people that apply to save, and there's a reason why I'm emphasising apply, and the average savings they actually look to save. And you can see there, the total annual savings contribution across all of those cohorts since 2019 is £4.1 million. So from the Ministry of Defence perspective, that is fantastic in terms of looking after their financial resilience and their readiness. To the right, since we implemented the programme, we've established it at Sandhurst for officer cadets, other training establishments. But I wanted to pick out Army Foundation College, Harrogate. Now this is a training college for individuals that are 16 and 17 years old, usually that are recruited by the Army that have come from quite impoverished communities. They've got a lack of financial education. So we start to brief them, considering their first take-home pay packet's about £1,400, and some of them have never had a paycheck before. So we're trying to encourage them to save. And you can see there, actually, we feel like we're doing quite a good job. From those 3 sessions, we've had nearly £1 million in savings over the course of a year from those cohorts. But again, as I said, I emphasise the point applications to save, because this is where the challenge comes. So KYC, know your customer, converting them from people that want to save to actual savers. Our conversion rate for Pirbright's about 59%. Where do we have the challenges? There's a lot of non-UK service personnel that join from British Commonwealth countries. They have thin credit profiles. They can't necessarily pass the AML checks when we try and prove their identity, even though they have been set up as an employer to work for His Majesty's Armed Forces, you know. So these people want to join, payroll's in place, but there's barriers that are stopping them actually wanting to start their savings journey. You look at Harrogate, 16 to 17-year-old, people that join the armed forces, again, they've gone through all the identity checks. Why do they fail the AML? Because they haven't had a credit before. They're living on military accommodation. They've got, you know, it's very hard to convert. There are ways we can speak to their chain of command and get a letter, but imagine going to a chain of command with 330 odd letters, it would soon cause a distraction. So we're passionate at trying to look at ways of how we can get more people saving, working with people in the room to try and, you know, where payroll savings is in place within employers to make it easy for those people that are in paid employment. So here's the video that we promised. Hopefully the sound's working.
The first time I heard of them was back in training when they came around to advise troops about how they can manage their finances and all that. And afterwards, after the education, I was actually pleased with it. So I signed up to save like £20 a month, which now I'm doing like 400 and something pounds. I think even more.
I think my favourite aspect of the whole thing is the savings, how money they get put in. I automatically get money into savings as well, so that my family, we have money left over as well.
So the credit union has helped me in a major way. The fact that I have problems saving, I'm just not disciplined when it comes down to saving, and it definitely helped me because it comes directly out of my salary at the end of the month, so I don't have to worry about that. I don't even realize that it's out of my pay, which is good.
The best thing of being part of the credit union is the feeling of being part of a big community, like big family, something that you can say you can rely on whenever that you need help.
So one of the best things of being part of the credit union is I'm able to save, I'm able to get a loan that I can afford, and I'm able to plan for the rainy days and get what I want at an affordable rate. I'm a proud member of the credit union, and best part is I'm already getting people to sign up with the credit union and they love it. I have friends that have joined because together we know that the future is more brighter with huge savings, with a union that can be able to take care of us when it comes to loans. And I'm a proud member, and that's one of my best parts of being a member of the credit union. Yeah, I love it.
So there's a few success stories, and you know, our members speak for themselves, and I'm conscious I've gone over the 7 minutes, but this is something I just want to highlight at the end. I've been to a lot of these sessions with Nest and different regulators, but sometimes we talk about payroll savings. I think sometimes we don't talk enough about the fact that it's actually a budgeting method called pay yourself first budgeting, and I think that's missed by a lot of employers. The fact that payroll savings helps people that really struggle to save. It's a budgeting method to help them save, okay? And we see that a lot with the credit union. The people that save because of the convenience, so we try and change behaviours from your traditional method, where you get paid, your bills come out, you spend your money, whatever left over, you try and save. However, paying yourself first, you get paid from your salary, your savings are already taken out, you can then, what's in your current account, you use that for your bills, your expenditure, and whatever's left over, you don't have to worry about saving because you've already taken care of it. It's really powerful. And just finally, you know, as a credit union, we're there to help our members save as an option if they need to borrow. What I will say, what I've learned from my journey with Serve and Protect, payroll savings has been really good for helping people that struggle to save to start saving, that psychologically struggle to save. The hardest thing about saving is starting the habit. If things progress in terms of the opt-out approach that I know is going to be discussed today, I think the most vulnerable people will then also get support in saving. Because those cohorts, within the military particularly, the NHS, global majority workers, they really struggle to set up savings accounts. And if employers can embrace that and recognise that helping those individuals that have gone through the employment checks for them to join, to assist them to start saving, can only be a good thing. I'll leave it there and hand back, and hopefully haven't gone too much over on time.
No, I think we're all good. Thank you so much, Robert. Really, really interesting. I love that framing of pay yourself first. I think that's really, really nice. We've got, I think, about 40 minutes or so for Q&A, so please prepare your questions. But while you're thinking about it, I'll just ask a few to get us going. Robert, you made, I think, a really important point in your presentation around how you can develop an approach with one employer, and that can work really well. But in terms of then scaling it to another employer, you need to think about context, you need to think about differences, how to adapt it. So could you perhaps tell us a little bit more about some of those kind of differences that you've encountered, and I guess kind of help us think about what that means for if we want to scale up these approaches more broadly across employers, what are the kinds of things we need to be thinking about?
Yeah, I suppose from our approach, I've shared some stats obviously with the military. Now, I'd love to say that, we're part of the training programme and it's launched by the Ministry of Defence. It's not. We managed to bolt onto the training programme, and some of the training establishments take it upon themselves to promote the message of the credit union. Even though we've got that kind of data, still some of the armed forces, some of those establishments don't promote financial resilience. So that's a real challenge. We've tried to replicate the same thing across different police forces. Some have embraced it, others haven't. I'd say one of the hardest things is speaking to people, particularly mid-service throughout their career. So we ask, if we can speak to the recruits, if we get mandated time, then we can educate them on financial resilience, and the savings pattern starts. However, time is a premium, particularly within the training establishments that we work with. So we appreciate that there are different priorities. And I think it's trying to identify where the priority lies for the employer, what their objectives are, and then trying to work your message to assist their objectives and help them out in their day-to-day job. And then once you make that connection, it becomes a lot easier, the doors open, and you can kind of get them on side.
Brilliant. And before the panel, I think you gave me quite a nice little example of how you'd, I think, adapted the approach for certain part of the military, Gurkhas, right?
Yes.
Yeah, so, would you like to just give us that kind of practical
So payroll
example?
savings, our products are just the regular savings product that comes from your pay. That's our core product. However, we market it to different communities that we serve. So, for example, the Gurkha Regiment, we serve a lot of the Gurkhas, help them save for their visa to remain. At a certain point in their career, they're going to want to bring their families here. It costs a lot of money. I know that changes regularly, but we encourage them to start saving for that. And it's fascinating, really. I had a conversation with one of the British Commonwealth soldiers who was a new recruit, and I said, "What is the big expenditure item you will pay for each year?" And he said, "I want to fly home to visit my family at Christmas." "How much does that cost you?" £3,000. So I said, £250 a month. If you save that every month, that will pay for your flight home at Christmas to see your family. The penny then dropped for him, and he started saving. But it was really interesting until we actually had that conversation. His brain, he would never have thought like that. Even though, people in the room think that's probably common sense. Common sense isn't that common necessarily.
Yeah, I think that's so interesting on the sort of different motivations among different kind of groups of people, but also what you'll find as you go to different employers as well. Brilliant. Please go ahead. I think we've got some roving mics potentially. Or you can speak louder. If you want to just say who you are and what organisation you're from as well, that'd be great.
Absolutely.
Brilliant. Thanks. Really good question. Do you want to start with that one, Joe?
Yeah, very happy to, and I'm sure the other panellists will have things to say as well. So whilst it's right to say that right now we don't regulate buy now, pay later products, that will come, right? So the sort of data and insight that we can gather when we do that will be better. I think this factors into us for part of a kind of broader conversation that we have within the organisation and the stream of work that we're doing and work that we also do with the government as part of the Financial Inclusion Committee, looking at kind of how you can increase supply of affordable credit, and then clearly how you do that in a way that is sustainable for people, right? Learning the lessons that we learned from the past. And there are a couple of different ways that we look at that. One is really to try to drive and support innovative products and those link-ups and those that will try to carefully assess the data, use it, and build it into their product design. And the other is to basically apply the consumer duty where we can, right? Where we're looking at regulated products, because from that, the onus is on the firm to try and get a good outcome for the customer. They need to be able to monitor and stand behind that. And so looking for themselves at what is happening to the customer and then improving that situation if the customer is manifestly not getting a good outcome is what we want to see.
Thank you. Is there anything you wanted to add on that, Robert or Vivi?
So I won't say too much about it, but I just wanted to flag that as part of this broader programme of work on financial resilience that Nest Insight is doing, we do have a stream that's focusing on some trials, focusing on these debt-saving hybrids. But you'll hear a bit more about that this afternoon, so I won't just sort of flagging that.
Yeah, and we're taking part in that study, so it'd be really fascinating to see if our model has helped build people's resilience. All I would say is we see people at the start of their careers, mid-service. Sometimes they say they can't save because they've already got debt, and we appreciate that. But actually recognising that a lot of the work we do is debt consolidation. So people actually save money by paying off existing debt. So it's a way of saving, freeing up that money to get them some cash to start saving. And they save alongside the loan. Different credit unions got different models. So some have it locked against their savings. We allow them just to access it if they want it, trusting the member. And actually, we like to think if we substantiate it without advice, but just the education that we provide, hopefully, when they then finish that loan, they'll be savers for the future. And we're starting to see some really interesting life cycles of our members now, where at different ages, different challenges they face. Some join, they're borrowers, they're debt consolidating, but then at the end of their career, they're starting to be the real savers of the future. So, nice.
Brilliant. Joe, just while we're on the topic of regulation, and you briefly mentioned consumer duty there, I'd love to hear a bit more about your reflections on consumer duty and all of this. And I guess one of the reasons why I'm asking is that it does feel over the past sort of maybe kind of 9 months or so, there has been this perception as to is there a trade-off between more active regulation and economic growth? The FCA has been part of that conversation, but not just the FCA, the CMA as well. And what's your take on all of that? Is there actually a tension?
So I totally recognise that question, right, and the consideration around is there tension between, in our language, our secondary growth objective and then wider primary consumer protection objective. But I don't think the two have to be mutually exclusive. And with the duty, I'm going to try and explain why, right? So as a piece of regulation, the consumer duty is fundamentally about driving good outcomes for consumers. And as I said, we place the onus on firms. They are responsible for doing that proactively. It's supposed to be flexible enough as well to account for wider market developments and enable innovation in that regard over time. And it should improve trust in the system. So this is good for consumers, yes, but it should and could also be good for growth. We look at the system as a whole with the duty. So if you start off with the individual consumer element, there we go. We want individual consumers to receive a good outcome with the product or service that they are using. The firm aspect, so getting that culture right in the firm, focusing on, you know, continuous improvement, but then that market aspect, so increased trust and engagement should flow from those first two things. And I think there's some really interesting research that comes out annually, if I'm not mistaken, and has been doing for quite some time now, that is from the Institute of Customer Service, so the UK Customer Satisfaction Index. And it bears out like that kind of design and hypothesis that we've got, right? So those firms, and this includes financial services firms, who score above average on customer satisfaction for their sector, and that comprises things like how much do you trust your firm, what support does the firm offer you, how do they handle your complaint, how do you do your service design, so all things that are really aligned to the duty. Those firms that score above average for their sector generally achieve stronger financial results across a whole range of dimensions. So getting it right by consumers should be good for business too, and that's the way that we're approaching this.
Yeah, really interesting. All right, let's go to the front first, and then we'll come to you.
Does it work? Yeah. Hello, I'm Michelle Sutton from Suez Recycling Recovery. We employ 7,000 UK workers, a lot of manual, 65% manual workforce. So we work with TransSave Credit Union and do payroll automatic enrolment, have done since November 2021, and it's brilliant. Payroll facilitated savings. Now, my question is, can policy work together to... A lot of employers have been burnt by doing payroll facilitated savings because they haven't known best practice, and maybe they've kept that money in their account, and then HMRC have said they've breached minimum wage because of a technical breach. They're doing the right thing and they're not sending it to an employer's account. So that's one thing. So employers are burnt and they're wary, but they want to do the right thing. And also, could the Know Your Customer checks, when you're payroll facilitated, you've done all of the checks to employ these people, can that be simpler?
Brilliant, thank you. Just before I put, if we could just keep the mic for a minute, can I ask you a question? Is that okay, just before I go out to the panel? I'd be really interested to know, back in 2021, what were the reasons why you decided to bring payroll savings into the organisation?
So we had employees ask to create a savings scheme, employer facilitated, and we did that in October 2019, and we only had 3% take up. We flipped it to automatic enrolment with the help of the trial from Nest, and we got to over 50%. So it's that inertia, low confidence, especially the manual workforce who are lower income, and they just, the obstacle of signing up themselves, taking that time when they're hearing noise from other places about they're not financially resilient. So doing it for them, well, that was the trial. We took the step, and it obviously worked and paid off. So that's why.
Interesting. Yeah. So clearly a lot of latent demand there, but it's about implementing it well. Yeah. Okay. Who would like to take this question on? What can we do about supporting employers and avoiding them being burnt by...
I'm very happy to get started, but others will have more to say as well. I think, if I understood the two parts of the question going back, how do we get past employers having been burnt in the past, and then, can we look at making KYC easier? My colleagues in the audience, stop me if I need to curb my enthusiasm. We are super keen to get past employers being burnt in the past, and are, as part of, again, working with the government on their wider financial inclusion strategy, but looking at our own ability to do things, working with a range of stakeholders to look at how we can provide greater assurance to employers that would allow them to feel more comfortable with that. And we see that as a really important part of helping build financial resilience. So that is well on the list. And as a part of that, where people surface questions or issues around KYC, we are very willing to look at those and consider them. So we're open. Talk to us if there are things, those of you in the audience who are doing this and finding difficult. We want to know where there are regulatory barriers, genuine regulatory barriers, and if they're in the gift of the FCA, we are open to considering them.
Great. Anything you want to add on that, Robert?
Yeah, we'd obviously welcome that. It would make our lives a lot easier. However, I do, one of the key barriers we see is, I suppose, people's time as an employer. And they go, actually, the time it's going to take, the perception of how much it's going to cost in their time. So I do wonder, with this government's commitment to cooperatives, where there are incentives or for employers that do offer this, to actually have some kind of potential, savings from an employer perspective for the ones that encourage it and build savings, there could be mechanisms there.
Do you mean like sort of tax reliefs and things
well,
like that?
Possibly. That could, no, but sometimes that makes people actually, take action, where some of the employers sort of look at it and think in their in-tray, it's not a huge priority, but actually it could then be pushed a bit more from the top down.
Vivi, is there anything you want to add on that question?
So I think I'm probably not best placed to answer, because most of the research I do is more sort of desk-based and sort of. But I think just going to your point about the sharing best practice, because that is such an important part, and it's such an important part actually of the work that we do as researchers, and I think it's definitely something where, maybe there's more we can do in terms of like when we're coming, sort of, particularly when we're speaking to different employees about their experiences, collating that and how we sort of share that back with people, going beyond the sort of, we'll publish a report and here are our findings, but sort of then going back out, talking to people and relaying the sort of message back. But thank you.
Brilliant. Lady in blue. Do you want to grab the mic and then we'll go to the lady in blue who's been patiently waiting.
Oh, very quick, sorry. I'm Anna from Pay Captain. I just wanted to pick up on the point of additional barriers. Yeah. So we offer payroll savings as well, and we have great success. Once we've got those employers on board with, the idea of savings within Pay Captain, that's great. They're really happy with it. In order to get people signed up with this sort of auto-enrollment, this default on savings product though, we have to make a compromise over the product that we're able to offer to the individual employees. So if we want to do auto-on, which has great success, is proven to, we have to only offer savings pots with no interest, so no FSCS protection and no interest. If we want to do it with savings accounts, with the additional protection and the interest rates, that then increases the friction, and you see the drop-off, the drop-off is huge there. So what can we do around that bit? That's, I think, hopefully some of Michelle's point as well. We need to really get that, reduce that friction down so that we can offer better products to people, which surely is in line with consumer duty as well.
Is this because of KYC?
It is, yeah.
Yeah, can I say, I'm really passionate about this. I spend a lot of time writing detailed papers for the regulator and the Treasury, looking at how, I believe, within the existing regulatory requirements, we can make it work. And it really frustrates me when I would just really love some really deep, detailed engagement on this, because not only is it a functional barrier to individuals, it's a commercial barrier. So if you look at the main providers of payroll savings now, they do it at a loss, and I really strongly believe there's a huge commercial opportunity for deposit takers who love, we'll ask Protect and Serve to confirm, who love sticky retail money, right? But it's expensive if someone's got a low balance and you have to spend £2 on KYC and loads of time and energy shunting paper around. If you're operating in a closed loop, so you know the source of funds, why do we need to know who the individual is? And I'm really, really passionate about making that happen, because I think we'll have a commercial market. We don't need to be doing research, we don't need to be sharing ideas so much. We just need to remove that barrier and let businesses get in there. And there's some amazing products out there which would just be so much better and so much more viable and profitable, and there'd be so much more fat in the model, so savers would get more interest. Right now, well, Emily, you'll talk to it as well, but like Waystream, you subsidise your savings, which is a wonderful thing to do, but really, if it was not for the cost of KYC, I think it would be.
Is that your experience, Robert, as well? Does that kind of resonate with you?
Yeah, I think so. My biggest worry is we see it, some of those most vulnerable cohorts that don't convert, and then when they need our help, they won't have the savings built up because they wouldn't have acted on it again, and they'll be the ones that probably then try and borrow, and they won't access affordable credit responsibly. They'll end up going to payday lenders, high interest credit providers, and that's the cycle I'm really passionate about, and trying to fill that gap really, if we can prevent that.
I think some of this was directed at the FCA.
Yeah, and I'm probably going to disappoint everybody greatly, especially the two people that have asked the question, by saying I'm not in a position to give a running commentary on a business model for a specific firm right here, right now, but I'm sure you can appreciate that. I'm really keen, though, to have the detailed discussion that you have asked for, and happy to do that with the right colleagues at the FCA and feed that into the work that we are currently doing.
Fabulous. All right, lady in blue, you've been patiently waiting.
Hi, I'm Lucy Neville-Rolfe and I'm from the House of Lords. And I've got two questions. The first one, we heard that 3 in 5 adults reported difficulty when facing problems dealing with financial matters. So shouldn't we be doing much more on financial education in schools, in induction? I thought Rob's case study was brilliant, in universities and the professions and so on. There is a gap, it seems to me, that isn't joined up. And the second question is also about, shouldn't we be broader and more joined up? I mean, in the health sector, we have Welcome, for example, which I think is one of the biggest voluntary bodies in the world, and that's doing advances in health. This area seems very statist, very regulated. Can't we do more by enabling sort of charities? I mean, my mother used to run a little local charity for people coming out of mental hospitals, actually giving them houses, buying houses and painting them. None of that happens now. It's all down to the DWP. So I'd like to feel that one could go broader. And the homeless people, the beggars who I meet, 3 beggars every day when I go to get my coffee. And do I give them money? No, because we're told you shouldn't give them money because they can go to the social security. But surely communities could do more. I feel there's a sort of space for more. We need to try and find some of this coming back in rather than everything just being run by the state.
Brilliant, thank you. Okay, so we've got financial education, and can we harness sort of that more kind of community-focused action as well? Who would like to kick us off?
Yeah, in terms of your point about the financial education, yeah, obviously on the induction program, when we brief, we say, like, you're not educated at school about finances, your parents don't want you to borrow, they try and encourage you not to borrow, your employer doesn't want to talk about lending, for example, but a lot of them will aspire to buy property, and it's going to be the largest acquisition they probably ever have, but they don't understand what an APR is. So I think if you could get that embedded into in a really simple format in financial education in schools, it would make a huge long-term impact. And one of our lessons since we started briefing the military, we went in, quite a snazzy PowerPoint, quite complicated, and they said, no, Rob, strip it back. Average reading age, 8 years old, okay? When we shifted our messaging and really broke it down, we saw more people saving as a result and understanding the message. So sometimes I think there's a danger we overcomplicate things as well, when we can really break down those messages, simplify it for people, and actually just, get them saving, understanding borrowing a bit better, and just making better choices when the time comes.
And I think it's really interesting sort of what you say there about the kind of when the time comes and part of the onboarding process, because a lot of the evidence on financial education shows that it's really important that it's timely, that it comes at a moment where you're actually then going to do something about it, right? So, yeah, really interesting. Joe, Vivien, is there anything you want to add on either of those points, financial education or the role of communities, and like just thinking about what other sectors do, like the health sector, and do we need more of that thinking here?
Yes, so I think I think that they're both really, really good questions. And I think what I would say is I think there's a point that sort of bridges both, which is I think we probably need to think more about the different touch points in people's lives, sort of when's the right time to reach out to people with information, with support. And I think, definitely with the sort of the community-based initiatives, there is a lot of evidence suggesting that the sort of bottom-up approaches do work. The downside, of course, is that they end up being sort of disconnected, and I think the challenge is sort of how do we sort of bring these good initiatives together, and I guess ultimately to some extent it sort of boils down to funding, because everyone's sort of time is limited, our resources are limited. Well, how can we actually get people on board to sort of get this out there?
Thank you. Anything you want to add, Joe?
Just briefly to say that I think, where we don't have a statutory responsibility for financial education, we do a lot of work with partner organisations, including MAPS, and we find that when we've been looking at kind of tricky problems like supply of affordable credit, etc., doing work with a range of different bodies is really important to try and get to grips with the problem and then work out, a reasonable answer to it. So, I see a real case for kind of wider partnership working.
Brilliant, thank you. Yes, 2 questions at the front. Do you want to go first once the mic arrives?
Introduce yourself before. Michael Clark from Turn to Us, and we're a financial insecurity charity. I just wanted to pick one point up, I could pick up a lot of them, about the role of the DWP and homeless people. And maybe, yes, you knew this was coming. I think I'd point out that homeless people can't just go and apply for benefits. You need to have an address, really, or else it's very difficult. You need to have a mobile phone of some kind, access to digital. Try getting that without having a credit rating, which you probably don't have if you're homeless, which I think is a good example of the kind of systemic problems and the lack of joined up different silos across dealing with that, which we were talking about earlier. And that's not a problem that charities can solve. That requires serious policy.
Thank you. Is there a specific question you've got for the panel on that point? No, just comment. Totally fine, totally fine. Lady at the front.
Hi, thank you. I'm Jess. I'm from Monzo Bank. So one of the areas that we're really interested in is the role that technology can play in supporting financial resilience in the UK, as you can imagine. I think from our perspective, there's kind of 2 big gear changes on the horizon, and I'd be really curious to hear the panel's perspectives on key opportunities and risks about them. I think the first one for us is hopefully open finance, so the ability of a consumer to share more of their financial lives with trusted and regulated third parties or their banks. And the other one being, sorry to bring it up, but AI. I'd be really curious to hear your thoughts on the kind of key opportunities, key risks in how those 2 kind of technological gear shifts can support financial resilience.
Brilliant, thank you. Let's take that, and then I know there are a couple more hands, but let's quickly take this one first, and then we'll come back to the room. Who wants to talk about technology and products and opportunities? Anything to add?
I mean, I guess on a very general level, I absolutely agree with you, and I think we've already seen, to some extent, with the way that banking apps have developed and the way that sort of not just the nudges to sort of save regularly, but also the fact that you can sort of set up your app so that you're putting away, £50 a week or whatever you can afford. So I think we've already seen a lot of growth in that space, and there's definitely, I think, potential for more. I would say with AI, and I'll caveat this with I'm absolutely not an expert, and I think it is one of those areas where there is a lot of potential, but as you rightly pointed out, there are a lot of risks as well. And I think one of the key areas is really around data, individual data protection, and how that's handled. And I think that getting that right will also matter from a commercial perspective in terms of if we want to build consumers' trust, we need to be able to reassure them that the way their data is being used respects their privacy and their rights. And I think there can be a bit of a sort of skepticism around particularly private providers coming up with these initiatives which are ultimately positive and can have a really positive impact on individuals. But because they're coming from private providers, sometimes they can be sort of seen through a certain lens. And I think that's where, I think thinking about how we handle personal data is crucial.
So potentially an opportunity for scaling, but we need to think about the trust part as well to take up. I know there are a couple. Did either of you want to add on that, or should we go back to the room? Yeah?
I was just going to say, I imagine open finance can only be a good thing really longer term if people have more options available to them, and it keeps financial institutions on their toes to provide better outcomes. And in terms of the AI route, credit union, big thing about credit union is people helping people. There's a lot of people that just genuinely still want to speak to people and have that personal touch. So I think that's always going to be there from our perspective, and it's something that it's a real USP from our movement, and we're passionate about. So I'm sure we'll embrace it, AI, we'll see in time, but we have to, but we keep that personal touch.
Brilliant. Okay, so we've got a question here, and have you got a question too? Yeah?
Hi, I'm Emily Trant from WageStream. I want to pick up the technology thread.
Yeah.
And I read a really fascinating paper out of the US last month that found evidence that mobile payments not only correlate, but are causal in terms of higher spending. So as we take friction out of the system and as we innovate, we're creating behavior change. And I just want the panel's reflection on how we understand the behavioral science of the pace of technology innovation and how that flows through to product and policy and regulation, because taking friction out is a great thing. We all want to remove friction and we're not going to stop that. But really, almost quite scary that is now causal. So removing friction out of that process of buying things means people spend more without meaning to spend more.
Very interesting. Vivi, do you want to start on that?
Yes, so I think that is a really interesting point, and it is really the flip side of, in some respects, it sort of made it easier for people to set up regular savings and to be able to sort of adjust those. But then yes, if it's made it easier to spend as well, then that's, I'm afraid I don't really have anything sort of insightful to add. I just think it is a sort of a very interesting point and something to definitely keep our eye on.
Yeah, I'm not familiar with this research, but it sounds fascinating. I think that we try to reflect on that and the kind of behaviours that people are going to manifest through use of like all sorts of different products and services, again, in the duty. And we deliberately don't say removing friction is a great thing. We say positive friction can be really important for consumers. So consider in the balance of, getting the right consumer outcome, whether there might need to be frictions that are introduced in order to support consumers to get to a better place, right? There are other cases in which removing frictions would be really helpful. This is not in the context of contactless payments, by the way. This is just as a general piece. So, I think there is a kind of really important consideration for us, and we have a behavioural science unit that does, live testing, research, tries to support the policy making that we do at the FCA, because at the end of the day, you're grappling with trying to make kind of decisions that will support the market, but that also make sense for individuals, and that's a really key component of that.
I suppose from the Behavioural Insights Team, I've got a bit of a view on this as well, and I think it's exactly the same as yours, really, in that friction isn't necessarily a bad thing. It depends where you're putting it in, and in fact, there are some areas where, so for example, we do quite a lot of work on gambling research, for instance, and some of the products that banks can provide there in terms of gambling blocks actually put friction into the process, and they're there for consumers to turn on so that they can put friction in the way of themselves. So, very much I think depends on the product behaviour that you're considering. Will, I think you had a question as well, right? If we could get a mic over to you.
Am I allowed a question? Is that cheating?
I think
so. It's double cheating because Nida, it's really, I think, probably mostly a question for you. But I was just reflecting on the question you made earlier about trade-offs, in this case in the context of regulation. But I think back to the regulatory impact assessment around pensions auto-enrolment many, many years ago, which basically predicted that the impact on economic growth of pensions auto-enrolment would be initially negative, because of course you're shifting a whole bunch of money from consumption into savings, but then it would become positive because that money's going into productive money that can be invested and drive innovation and drive growth in the economy. And I just, as you're asking that question, I was just wondering if you got any reflections on, as we think about, you rightly said in your introductory remarks, kind of economic growth is so central to so much now. There's a decent chance, isn't there, that if we as a nation get better at financial resilience, it's going to cost in the short term and then be beneficial in the medium term. But whereas 20 years ago we could give up a little bit of economic growth because we had lots, right now we don't have lots. So how do we sort of wrap our heads around some of those time shifts and kind of figure out what's a good place to spend our time and what's not in the context of economic growth being so important?
Yeah, I think it's a very difficult question because I think you're exactly right. It's a short-term, long-term thing. Longer-term economies that are more stable have higher growth, but that is long-term. And how do you get to stability? It's a lot of these things, both on the kind of business side, but on the consumer side as well. Things that allow households to kind of weather storms when they come, help economies recover more quickly when there is a shock. But I think you've kind of sort of hit the nail on the head, really, with that sort of potential short-term, long-term trade-off. And I think it also goes a little bit to what you were saying earlier, Joe, around trust in markets. And that's, trust in markets is really important for long-term growth. How you get there in the sort of short term may be a bit tricky. Do you want to add anything on that?
No, well, actually, you said the same thing when we were talking about AI and sharing information. You said it's about trust as well, and I think fundamentally, like, there's a lot of opportunity, for example, for cost reduction in passing information across different distributors and chains using the tech that's available. But if people don't trust the provider enough in the first place, or the system to put their information in, we're going to struggle with it. So we've got to have kind of both bits, right? And the things that we try and support in our innovation pathways and innovation unit are like, we're really keen to look at stuff like that as well. But I think on this wider question, we absolutely need to think about interventions holistically. You've got, Vivi, you mentioned it a bit, this kind of, access to high-cost credit might give like a short-term boost to GDP whilst people spend, but it might not alleviate any drag on productivity and growth from stress-related illness that people might suffer because their resilience is low. So I think we'd recognise this case that there are some kind of, there's a fair bit of evidence in relation to savings and investments that says, like, if you take some actions that are needed for sustainable long-term growth, you might take a hit in the short term. And as policymakers, we've really got to recognise what the trade-offs are on that and think about what our kind of end goal is to try and get there.
Yeah, absolutely. We've got 5 minutes left. I know there are a few hands, so I wonder if perhaps we just take a collection of 2 or 3, and then we can come to the panel for sort of final thoughts. So I see one there, one there. Oh, maybe. Oh, okay, one there. Should we start with this one over here? Yeah.
Oh, hello everyone. I'm Peter Sutton from Step Change. Just going back to the friction point again, and that being very important. So we did a bit of polling a while ago and looking how people cope with crisis, and looking sort of, who was using local welfare support. About 13% of respondents. It was well targeted but low numbers. Who was going online shopping for credit? 60%. So there's a thing here about different frictions to access different things. And there's a thing here about how things that are financial services tend to reduce friction more quickly than public services. So the way that people meet their needs is being influenced by the shoe leather costs rather than what's actually best for them. So I guess 2 points here arising from that. One, in terms of how we're thinking about financial resilience, do we need to sort of do a segmentation model like in the financial inclusion debate of where do commercial services work, who are the people where commercial services aren't going to work for, what does the public sector have to do, what does government and policy have to do? And second to that, in terms of business cases, have any thoughts of what's the business case for better investment in safety nets and public services to increase financial resilience and reduce some of the harmful side effects of the wrong use of credit? If anyone's got any thoughts on that.
Great, thank you. And before we go back to the panel, I think I saw a hand around there somewhere. No? If not, we've got one here.
Hi, Chris Busey from CHASM, which is a research centre in the University of Birmingham. My question is really for you, Rob, but would like to hear all your thoughts as well, if relevant. But I'm just wondering, I love the phrase in pay yourself first. I hear it a lot in my research, but only really with the people that are good at saving. And your slides show that it's obviously a good mindset to have. I'm just wondering if in your experience, if you've ever had people come to you who either don't have enough money to start with to have that mindset, or have an uncertain sort of volatile income where they can't start that mindset, but obviously having that savings would give them that cushion to carry on that mindset. I'm just wondering if you've ever had that.
Yeah, no, it's a great question. We've, for example, the stats I showed you from the military, and they quite unique circumstance. They've got a lot of money left over at the end of the month because a lot of things are paid for. The next day I'll be briefing police officers that have joined that can't afford to pay for a tank of petrol to get to and from work, so they've taken a pay cut. They can't find £10 to save with a credit union. So we then shift it. We talk about the education, trying to understand where they're spending their money. The amount of officers that will have a cup of coffee in their hand from Starbucks and say, I can't afford a tenner. And then we make them realise, your behaviours, your choices, looking at your wants and needs, identifying, when you're spending stuff, what's a want and what's a need. The hardest thing about saving is starting a habit. So we lay that into the foundation. They then realise, actually, I can make a few choices, change my behaviours, start saving, soon build it up when you get a promotion, etc. And we also then push about savings goals as well. So we know throughout their life and their career, there are going to be certain things they're going to want to buy throughout their life. A lot of people don't know how much these things cost. So when we highlight that to them and then go, actually, if you're looking to buy that new car for work, do you realise the average price for a 3-door hatchback is about £22,000 brand new? Didn't realise that. If you can start your journey to save towards it, even if you can't save it all, even if you save a little bit, it starts the habit. And then, you know, add the pay yourself first budgeting from payroll, and we see people then starting to save. From originally have the conversation that say, I can't find a tenner to join, Rob, and all of a sudden they're now savers for the future. So, hope that
thank you. Would any of you like to take the question on friction and sort of this issue, sort of friction to access public services and welfare and benefits versus commercial products?
I wondered if that might be where you got to, Peter, in terms of like, you know, how can you look at a model, something that the wider research might end up considering? Is that?
Yes, yeah. So I think on both those points, on the frictions and also the segmentation, which I guess is interrelated, and I think it is one of the things we're sort of hoping to get to through our work, not just the work we're doing sort of looking at particular interventions, but the sort of work I'm doing on assessing the wider economic impacts. And we hope that by highlighting the benefits to different stakeholders, it will give us a sort of a basis for bringing more people on board. But absolutely, sort of part of that work will be, as you say, thinking about what role is best played by which sort of stakeholders or agencies.
And Vivi, if I could just sort of ask you a final question. I'm going over time to do this, but I'm really interested in terms of your work. How far off do you think we are from being able to say, you know, if we invest this amount in terms of rolling out savings products of this kind, we could be increasing growth by X, we could be, you know, reducing the longer-term welfare bill by Y, and where do you think maybe some of those gaps in the research are that we kind of need to collectively fill?
Oh, that's a really good question, and a very difficult one, because, and I should caveat it with, I tend to be ridiculously over-optimistic about what can be achieved. So I'd say whatever I say, just add on a couple of months to be on the safe side. But we are hoping to get a sort of first set of results around September time. I mean, that will be sort of very early stages work, but over the course of sort of towards the end of this year and beginning of next year, we're hoping to get our first sort of, say, good numbers in terms of what are these like wider economic impacts looking like. And just very quickly on the data, I think there are two things really. So one is there is an awful lot of really good data out there. So there's a financial life survey, obviously, but also wealth and assets and understanding society. And so part of my work is going to be looking at these different data sets and sort of what can we learn from them. But we're also hoping to learn a lot from the trials that we're running and the sort of the data that we'll be analysing as part of that process. And one of the things, and this is, I guess, a sort of challenging one, but something that we are hoping to do is to try and get a sense of how can we go beyond the sort of immediate short-term impacts of these interventions and understand, well, what effect do they have, I don't know, 12 months down the line, and how do these sort of, how do you get into a sort of virtuous cycle of impacts? But
brilliant. All right, well, we should end it there and let you all get to lunch. But I just want to say I think it's been a great discussion. We've touched on lots of different aspects of how we actually scale up these ideas. I thought there was a great discussion here around, you know, how the market could potentially create much more of a scaling effect if we get those sort of policy and regulatory conditions right. Some really kind of interesting, I think, research, it sounds like it's going to come from you over the next few months, Vivi, that I'm sure we'll look out for. But I think let's just all sort of keep this in mind as we kind of go to lunch and think about the next panels and in our work, is sort of how do we get this to the next stage of scaling, and what data do we need to be collecting, what kind of testing do we need to do now, do we need to carry on testing, but how do we get to that longer term goal of scaling up these really excellent ideas to improve financial resilience? But I will leave it there. Please join me in thanking the panel.